Alright, dear students, welcome back to National Income and Related Aggregates Macroeconomics. Okay, so in the previous session we have learned the various basic concepts like intermediate goods and final goods, depreciation, capital, investment. We also learned what is the difference between stock and flow, then moved on to circular flow of income. Then we also learned the concepts of economic territory and resident. So how to identify whether this question is in the question what is being asked is a resident or a non-resident, and whether this is these things belong to economic territory of a country or not. So these are the things that we did in the previous session. Now in this session we take up the topic on related aggregates, right? So related aggregates, these are the related aggregates: market price. We have net domestic product at market price, GDP at MP, then NNP at MP and GNP at MP. Similarly, four things for factor cost, four aggregates. But before that, we should know the golden rules. So what are the golden rules? Gross. Gross, you can get the net by subtracting depreciation. So if you subtract depreciation from the gross, you get net. So net plus depreciation will give you gross, or gross minus depreciation will give you net. So that is the first golden rule. So that will help you to convert this gross and net. Right. So moving further, national is always equal to domestic plus net factor income from abroad. So national is equal to domestic plus net factor income from abroad. But net factor income from abroad is what? Factor income from abroad, and the difference between factor income from abroad and factor income to abroad. Then what is market price? Market price is equal to factor cost plus net indirect taxes. So what is net indirect taxes? Indirect taxes minus subsidies. So these three golden rules will help you to find out the relationship between the national income aggregates and also how to calculate the national income. So now what we do is let's learn to apply these golden rules. Now suppose you are given in the numericals, which we are just going to solve. In the numerical, suppose this is GDP at FC is given to you in the exam, and you have to calculate NDP at MP. So GDP FC, what should you do so that you get NDP at MP? So gross minus depreciation. Gross minus depreciation will give you net. Then how do you, domestic and domestic is same, and market price, how do you get factor cost, how do you convert to market price? So plus net indirect taxes. And what is net indirect taxes? And net indirect taxes is indirect tax minus subsidies. And what is indirect tax? GST. Now all the indirect taxes have been merged into goods and services tax. So that is the biggest reform in indirect taxes in last all these years, right? So now suppose you are given GDP at MP, and you are given NNP at FC, and you have to calculate GDP at MP. So net national product at factor cost is given, and you have to convert it to GDP at MP. So how do you go from net to gross plus depreciation, and how do you go factor cost to market price? In fact, before that, a national to domestic. Now you have to find out domestic from national. So minus net factor income from abroad. And then how do you calculate market price? Market price for this you will do plus NIT. Plus NIT. Now before we do these numericals, what are these 8 national income aggregates, right? So this, how do you define it? So no need to wrote it. You have to understand the technique, how we study this. So here market value of, so let's say GDP at MP, because this everybody knows. You all also study GDP at MP, the definition in class 10th economics. So GDP at MP is money value of all goods and services produced within the domestic territory. All goods and services money value produced within the domestic territory of a country in an accounting year. So how do you define now NDP at MP? So you have to exclude depreciation. So it is defined as money value of all goods and services produced within the domestic territory, exclusive of depreciation, right? Exclusive of depreciation. Now, what is this, the difference between domestic and national? So domestic, it is money value of all goods and services produced by both the residents and non-residents in an accounting year, because domestic means both the residents and non-residents in that country. Or you can say money value of all goods and services produced within the domestic territory by the residents or the non-residents, by the residents and the non-residents within the domestic territory in an economic year, accounting year, exclusive of depreciation. Let's see one more. So money value of all goods and services produced by the residents now, because now national, this N means residents, national. Resident is a national concept. So money value of all goods and services produced by the residents of a country, exclusive of depreciation. And here it is money value of all goods and services produced by the residents and inclusive of depreciation in an accounting year. Now FC means factor income generated. So factor income is rent, interest, profit, this wages, rent, interest, profit. So payment to factors of production. So now we define 4 aggregates in terms of payment to factors of production. So this is factor income generated by both the residents and the non-residents within the domestic territory, exclusive of depreciation. So here factor income generated within the domestic territory by both the residents and non-residents, inclusive of depreciation. Here factor income generated by the residents, exclusive of depreciation in an accounting year. So children, these are the 8 aggregates and this is how you prepare the definition. So no need to rote, go for the technique where the most important thing is for domestic you say both the residents and non-residents within the domestic territory, and for national you say only by the residents. So now let's take some more. So for example, you have to calculate now GDP here and FC. So now how do you go from gross to net? Minus depreciation. How do you go from domestic to national? Plus NFIFA, right? And then MP is plus NIT, plus NIT. Now suppose let us take this concept. So here suppose I give you NNP at MP is given in the exam, NNP at MP, and you have to find out GDP at FC. So how do you go net to gross plus depreciation, right? And then national to domestic, you have to go from national, you have to work out domestic, so minus net factor income from abroad, minus net factor income from abroad. And then factor cost, so minus NIT. Minus NIT means minus IT plus subsidies. Suppose I take up one more. So suppose you are given with GDP at MP and you have to work out this. So, gross is same. Now domestic and national, you have to work out national. So you have to work out national, so plus NFIFA, right? And then then you have to find out factor cost, so minus NIT, and depreciation not required because both are gross. So children, this is the way to find out, to work out the numericals on related aggregates, the concepts of related aggregates using the 3 golden rules. Now if we see some numericals here, so these are the numericals. So let's take the first numerical. Now here you have to find out GNP at MP. So you have to find out GNP at MP, and what is given to you? NDP at FC. So you are given NDP at FC. So net to gross. So plus depreciation. Domestic, say you have to go, now you have to calculate national. So plus net factor income from abroad. And MP you have to work out, so plus NIT. Now give me the values. Let's see the values. So here I'll just the space, I'll use the space here. So NDP at FC is 35,000. Depreciation is 700. So keep on adding. NFIFA is factor income from abroad minus to abroad. So this is 50, 50, and then NIT is indirect taxes minus subsidies. So GST minus subsidies. GST minus subsidies will be 9,000 minus 1,000, right? So indirect tax minus subsidies 8,000. So if you sum total all this, the answer, you will get the answer. So this is how you apply this for the numericals. Let's see another numerical. So here you have to find out NDP at FC, right? NDP at FC, what is given to you? GDP at MP. Now here gross and net, so this will be minus depreciation, right? Minus depreciation. So domestic is same and minus NIT, and then you apply the form. So first you use write the formula, state the formula using the golden rules, and then you apply put the value, substitute the values. Now what is net factor income from abroad? So net factor income from abroad is factor income earned by the residents employed abroad for less than 1 year, and you subtract this with the income earned by the non-residents, with the income paid to non-residents within the domestic territory, employed within the domestic territory for less than 1 year. So it has three components: net compensation of employees, net income from property and entrepreneurship, and net retained earnings. Now what do you mean by net compensation of employees? So it refers to the difference between what our residents are paid by the rest of the world when they are employed abroad, and what we pay them, we pay to the non-residents who are living in who are working and employed in our domestic territory for less than 1 year. Similarly, net income from property and entrepreneurship refers to the difference between the income in the form of rent, interest, dividend received by our residents by the rest of the world, and they are working when they are working abroad for less than 1 year, and what we have paid to the non-residents who are employed in our domestic territory for less than 1 year. And similarly, net retained earnings is the difference between the retained earnings of our companies in the rest of the world and the difference between the retained earnings of our company in the rest of the world and the companies which are situated in our country for less than that belong to abroad for less than 1 year. So it is a sum total of net compensation of employees, net retained earnings, and net income from property and entrepreneurship is what is net factor income from abroad, or simply a difference between factor income from abroad and factor income to abroad. And in the numerical, if it is net factor income from abroad, then you add it to national to find out the national income. You add it to domestic income to find out national income. But if it is net factor income to abroad, then you subtract it to find out the national income. So factor income from net factor income from abroad is added, net factor income to abroad is subtracted. So with this, see you in the next class, and in the next class we will study measurement of national income. Thank you.